Welcome back. You're still tuned into Markets at Noon right here on ET Now. And let's now put the spotlight on the macroeconomic trends and the kind of demand that is expected to shape up in the second half of the year. To understand this, we now have Kinjal Shah, Senior Vice President and Co-Group Head at the Corporate Ratings ICRA, now joining us. Kinjal, afternoon, and thank you so much for joining us today. I was just going through your latest report which says that festive demand and GST rationalization are likely to aid demand in the third and the fourth quarter of this fiscal. If you can take us through some numbers, how much demand growth are you penciling in, and which factors other than festive and GST rationalization are expected to aid this kind of growth?
Good afternoon, and thank you for the question. We're expecting about 8 to 10% YOY growth in revenues for the quarter 3 of the fiscal. And this will be primarily led by two reasons, like you rightly mentioned. One is the GST rate rationalization, and the second is the festive demand. So we've already seen October seeing very good signs of recovery in demand, especially for consumer-led sectors like the auto and retail and hotels, where the GST rate rationalization has spurred the demand. We've also seen sectors like the jewelry industry, hospitality industry overall, continuing to see growth from the festive demand. So overall, we did see Q2 YOY revenue growth of 9.2% for the sample set that ICRA tracks for roughly 2,900 plus listed entities. And we expect that this sample set should witness about an 8 to 10% YOY growth in revenues in Q3 of FY2026.
Right, that's the expectation we have. But I also want to understand your rural versus urban play, because that is something which you are mentioning that there is an uptick. What are the factors you're watching?
Yeah, so on the rural side, the demand recovery did start panning out from last year onwards, and we're seeing the rural demand to be resilient in the current year, aided by strong cash flows from the farming community. While obviously the early onset of the monsoon and the unseasonal rains, they did have some impact, but overall rural economy has remained quite resilient. On the urban side, coupled with these GST rate rationalization, the expectation is that the easing inflation, the benefit of the income tax relief provided during the Union Budget 2025, as well as the overall commodity prices remaining quite benign, and the interest rate cuts of about 100 bits that we've seen between February 2025 and November 2025, these should spur up the urban demand, and we should see some kind of an urban demand recovery setting in Q3 and following up in Q4 as well.
So that's as far as rural versus urban demand is concerned. But Kinjal, also wanted your thoughts on tariffs and the kind of impact that has had on your estimates. And now there is a lot of buzz that perhaps a deal between India and US could be signed over the next few days. How will your estimates change in that case?
Yeah. So as of now, our estimates do factor in that the exports for certain such sectors like auto, IT services, agrochemicals, cut and polished diamonds, seafoods, these sectors would continue to see some impact, as we've already seen that starting September. So our estimates do factor in the subdued exports overall for corporate India until these high tariffs along with the penal tariffs that are levied continue. But yes, if there were a favorable action towards the overall tariff rates, there will definitely be a positive upside to our estimates.
Right, and there has been an impact of prolonged monsoon as well, and for that matter, now the AC sales were not as much as it could have been. Do you think that when the Q3 numbers will come, that will be offset?
So in any case, I think Q2 typically is not a very big season for AC sales, but definitely the festive season does result in a pickup in AC sales. Now, there are two things which will actually drive the AC sales during Q3. One is the GST rate rationalization, and the second is there are these new energy efficiency norms which are applicable from January of 2026, which would result in some 6 to 8% price increase as per ICRA estimates. So there could be some pre-buying which can happen before the new energy norms set in, in January. So Q3 could probably benefit from the pre-buying for that as well. So Q3 would definitely see some benefit both from GST rate rationalization and the pre-buying.
And Kinjal, what kind of risks are you factoring in when you've come out with this kind of report and projections for the third and fourth quarter of this year? Do you think if at all the tariff deal were not to go through, then what kind of impact will that have, or any other risk, geopolitical risks for that matter?
Right. So there are certain headwinds which continue for overall corporate India. So one of them being the steep US tariffs, which I mentioned earlier in my comment that as of now our estimates do factor in that the US tariffs would continue. The second headwind currently is also the geopolitical tensions that you mentioned. So sometimes there are certain disruptions to the supply chain because of the geopolitical tensions. The third headwind currently is also there has been some deferment of private capex because of this entire ambiguity around the tariffs, uncertainties, geopolitical tensions. We're not seeing a lot of private capex coming up. Like I said, while urban demand recovery is panning out, there has been a delay in the urban recovery. And one needs to see that the festive demand recovery which has set in, how much is that going to be sustainable? So these are some of the headwinds that we have factored in our estimates. And anything which would be a positive to these headwinds will be an upside to our estimates from the 8 to 10% growth that we have forecasted.
Right. You mentioned about the private capex, and that is something which has been a talking point in last 1 year or so. Even finance ministers and other has given statements on the same. But you also mentioned about government capex, which is likely to be moderate in H2 FY2026. Can you throw light on the same? And is there an expectation by Q3 or Q4 that even private capex can pick up?
Yeah. So on the government capex side, I think the budgeted estimates had seen some 6% growth over the previous year, and H1 I think has been much better on a YY basis. So that's why the expectation is that the H2 government capex could be slightly contained. On the private capex side, while there is overall some deferment in the capex, but there are certain pockets or certain sectors within the corporate India where we continue to see private capex. These being the semiconductors sector, the electronics sector, the data center sector, and in certain pockets of the auto sector, especially the electric vehicles. So there are a few sectors where we are seeing the private capex continuing. Obviously, those are also fueled by the government incentives of PLI and other schemes. So these do fuel the private capex, but overall we are seeing some deferment of the private capex until the headwinds of the geopolitical tensions, the US tariffs, etc. Are done away with.
All right, Kinjal, we'll leave it at that. Thank you so much for joining with your views on your report. With this, it's time to take a very quick break, but don't go away. After the break, a lot coming up.